Welcome to the Superintendent's Hangout, where we discuss topics in education, charter schools, life in general, and not necessarily in that order. I'm your host, Dr. Sharetta. Come on in and hang out. In this episode, I sat down with Eric Sams, founder and president of E&E Financial Services. Eric started the company while he was in his early 20s with one goal in mind: to create a firm whose sole focus is its clients and serving their financial and investment needs. E&E Financial operates in an independent and unbiased manner, and as Eric describes in the episode, he is a fiduciary rather than a broker, and he speaks to the difference between those two designations. We talk about a range of topics, including cryptocurrency, hedge funds, golf, the importance of setting up a family budget, the importance of enjoying life because it's the only one we have, but also planning for the future. I hope you enjoy this episode as much as I did making it. Welcome, Eric. Thanks for coming in and hanging out this afternoon.
Good to be here.
I wanted to start with allowing you to share your origin story. But before that, I understand you have a bit of a disclaimer, so I'll let you do that as a professional before we get to the fun stuff.
Sure. So Eric Sams, president of E&E Financial, really excited to be here and be chatting with you. Before we get into everything, I do just have to put out there that anything discussed today is intended to be informational only. Before making any sort of actions or taking any decisions financially, be sure to consult your financial advisor and make sure that you speak with a professional licensed person before acting on anything that may come out of the show.
Great. Thank you for that. And that's just to protect everybody. And now we'll get to the fun stuff. So if you could share your origin story, where are you from and what got you into the line of work that you're in right now? And then we'll take it from there.
Sure. Yeah, absolutely. So born in Los Angeles, lived there until I was 5. My dad always worked in finance, and that was kind of my original inclination to wanting to be in the business and my initial interest with it. And my dad's been my best friend, mentor, look up to him a ton and have a bunch of respect for him. So I always was just interested in what he did and wanted to be like him. We moved from Los Angeles to Orange County in, I guess, I don't know what year, so probably 94, 93, something like that. And my dad worked on the floor of the Pacific Stock Exchange. So Pacific Stock Exchange no longer exists. It's all, New York now. But there used to be the equivalent of a West Coast exchange, such as the NYSE or New York Stock Exchange.
That was in LA?
Correct.
Okay.
Yep. So my dad would commute from Orange County to Los Angeles every day. He would work market hours. So I remember as a little kid, it'd be like 3 a.m. and I'd kind of stir in my bed every once in a while. I'd hear the garage opening in the morning for my dad to leave. And the cool thing about that was he was gone super early, but he would get back and pick me up from school every day because he was working market hours. By the time the market was closed, he'd come back down from beat traffic and he'd be able to pick me up every day from school. The cool thing was every once in a while, he would take me into the office with him, or I guess to the trading floor. And I was, 7, 8, 9, 10 years old when I was doing this with him. And I just have really fond memories of it where we would go stop and get donuts. It was like pitch black out. And again, we're up at 3 o'clock, but I was super excited. Wasn't tired at all. Drive to LA. And I just remember, you think of the 80s and 90s Wall Street movies where it's like the trading floor, right? And people are screaming and it's open outcry and there's paper flying all over.
Chain smoking.
Correct. 100%. So as a kid, I didn't know what it was. I didn't really understand what finance was or what my dad was doing he was a market maker on the exchange. But I would go and it was like some of my best memories of just the craziness. And as a little kid, I'm like, I don't know what this is, but this is cool. And just seeing the paper flying, my dad would give me a little slingshot and I'd crumble up old trade orders and shoot them out into the trading floor. So I just have a ton of fond memories of that, and which is why I originally wanted to get into financial services. So anyways, came down here to San Diego for college, went to UC San Diego, got my degree in econ, minor in urban studies and planning, and started doing some internships. And after college, got my first job at a large financial services firm, and that was kind of my foray into where I am today. And I've kind of bobbed and weaved a little bit within the industry and done some different things, but that's kind of the how I got here and why I was interested in doing it in the first place.
So it sounds like you've spanned kind of the old school, as you say, kind of the old Wall Street movie genre type of setting.
Yep.
To coming to the present moment where on some level financial services have become democratized and super accessible. You can, on an app, and fees have gone down. We can talk about that in a little bit.
Yep.
And I think largely those are positive moves, but then it's also really susceptible to either market manipulation by, you see these Reddit things. Everybody go buy GameStop. By the way, I'm not giving advice to buy GameStop right now, and Eric certainly isn't. But you saw what that does, right?
Correct.
It's this grassroots level. So I was wondering if you could talk about where your company's sweet spot is, because what brought us together is that you work with a lot of educators. And financial planning, really a lifelong relationship that you try to cultivate with your clients.
Yep.
So how do you operate in this environment where if someone wanted to go out on their own and do everything they could from their iPhone, what's your selling point for the services that you provide?
Sure. And I would say too, to your prior point on the Reddit threads and things like that. Again, you watch like the Wolf of Wall Street movie. The kind of penny stock, pump and dump stuff has always been around. And to an extent, I would say, I don't know when it was worse or better. Neither are good, obviously. But, in like the 80s or 90s, some stockbroker calls you up and they're like, hey, I got a hot tip on XYZ company. You don't really have much of an avenue to research that. And you're kind of, again, if the guy sells you and if it's a bag of goods, it may be. At least now, like when you see stuff, there's, not to say everything on the internet's true, because it's not, obviously. But you do have, as an individual, a much wider array of resources to try and vet something before you do make a decision. So it's the scammers are always there and always have been there, and the good guys are always there and always have been there. And to your point, as far as like what we do and our value add, a lot of people in those situations may end up being more susceptible to kind of like the hot tip, right? Like, oh, I had a buddy who went on Reddit and found this stock and made $1 million, or, this crypto, or fill in the blank of whatever the hottest investing trend is. Our goal is to take people who a lot of times may not get good advice because they don't have $1 million, right? Like you go to Morgan Stanley, Merrill Lynch, and you walk in the door with $1 million+ bucks, they'll roll out the red carpet, you'll get a great financial advisor, and they'll give you good advice. You go knock on one of those doors and you say, hey, I'm an educator, I've got $10,000 and I'm looking to put money away for myself. I'm trying to help my kids with college. I want to make sure there's something happens to me and my family's taken care of. Unfortunately, a lot of people will not either A, service that type of clientele, or B, that type of clientele gets serviced by people who are a little bit more unscrupulous and are trying to extract more money out of each transaction, given that they're working with smaller dollar amounts. And so I think we'll probably get into this at some point in the conversation, but that's really where the value of working with a fiduciary is, and somebody who's going to be working in your best interest. And our business model, I'm 35 now. I started basically when I was 22, straight out of college. So I was never in a position, obviously I wanted to be successful, but I wasn't like I needed to get rich quick. And I did try and work with large dollar value people. But as a 21, 22-year-old kid, I didn't really find too much traction. So my first job out of college that just happened to market to educators taught me how to get in front of those people and how to help them. Unfortunately, the products and services that they were offering, I didn't really agree with, which is where I went independent and decided to kind of go do my own thing. But my goal was always, hey, look, if these educators who I'm realizing are not getting a lot of help, at that point, I wasn't really able to make any progress on people with larger amounts of money. And I was like, well, this is a great opportunity for me to A, grow my business and get into a marketplace where people need help and aren't really getting it, and kind of cut my teeth and grow the business. And then over time, it just kind of stuck with it. I gained traction, got referrals, and it was kind of a nice thing to be able to put my head on the pillow at night and feel like, hey, these people are good people. They're just trying to, again, take care of their families. And a lot of times they don't have people that are either A, giving them advice, or the people that are giving them advice are not necessarily doing it in their best interest.
It's interesting because sometimes people think of investing or just matters related to money in general as math. Mm-hmm. But it's as much psychology as anything else, mm-hmm. right? The psychology of money, depending on, there's actually a great book of that name, The Psychology of Money, that talks about depending on what generation you grew up in. If you grew up in the 70s, you remember your parents with mortgages of 15%. If you grew up in the last, 10, 15 years, right. especially leading into COVID, you remember interest rates that were almost zero. Mm-hmm. So depending on, and if you grew up and your parents lost a house during the Great Recession, you remember ARM loans and never get a variable rate loan ever for any reason. Mm-hmm. And so it's interesting how that psychology gets baked in, just as if the same way if you have family members who lived through the Great Depression, yep. or, grandparents. I have my late grandparents lived through the Great Depression, and I think I can see signs of that rolling forward in our family mm-hmm. history and legacy related to money. What kind of how are educators? Because I know you service a lot of educators, a lot of teachers, and mm-hmm. other school personnel, but not exclusively, but a lot. Mm-hmm. Let me see if I can phrase this correctly. How is that a unique market, and what are some of the special needs that those folks have that you can meet with your services?
Sure. So educators in general are very giving people and tend to be focused on the kids, right? Most people are not getting into education to do it for the money. Most people are getting into education for the love of education and helping the future generations and making a difference in the world, right? They tend to be very busy with their own families, and then again their families away from home, i.e. the kids at school, right? So I think the biggest challenge is them finding time to be able to allocate to this, and then also to another barrier that I found is teachers are educated, right? A lot of them end up having masters. They have to go to a bunch of school. Financial planning and investing can be a very intimidating thing. And so I think a lot of times educators just kind of shy away from it because they're like, I'm smart, but this thing over here, I don't really understand it. And so I'm kind of afraid to put myself in a position where usually like I'm a smart person and know how to figure stuff out. And it can be in situations where you know what you're doing, and it's a little bit getting outside of their comfort zone of kind of having to be like, I don't get any of this. And a lot of times, like my favorite meetings are clients that come in, they're like, I know nothing about this. Like, what do I do? And I'm like, this is awesome. We can do some good here. And like, they have an open mind about it. So getting people to that point when they know they're smart is kind of hard to break down that barrier for them to say like, what do? I need help. And so that time and commitment wise of their individual families and then the kids at school, and just, they tend to be giving and self-sacrificing. So it's like, hey, I can take some time to prioritize myself, or like, hey, this kid might need some after school studying. Teachers tend to gravitate, again, for the right reasons, to helping the kid after school and sacrificing maybe their own well-being sometimes. So getting them to find some time to take enough time and effort to put into these things that are really important for them in the long run, and getting them to feel comfortable to, I guess, kind of be vulnerable and be like, hey, I don't get this. What do I do?
And I'd imagine most educators are on kind of a slow and steady path, right? I mean, mm-hmm. the nature of most, certainly in the public sector, most compensation for teachers is a fairly predictable trajectory over time, sometimes over decades, as opposed to someone who's in a commission-based line of work where their income could skyrocket or plummet right. year to year.
Right.
So it's probably an interesting philosophy around investing.
Yep. Well, and that is, again, the downside from a financial planning perspective purely is typically educators aren't making millions of dollars. The good news is they have good benefits. They have a very strong pension system. And I guess another barrier to your earlier question is getting them to start early. And it's amazing, like how many educators in your position are kind of my best salespeople, where they're like, man, like I've been working with Eric for 5 years, 10 years, and I started when I was 45, 40, 50, whatever it may be. Like if only somebody grabbed me at like 25 when I first got my teaching job and said, hey, put $25 a month away. And just, again, as you get those scheduled raises, just now do 50 and then do 75 and then do 100. And you can sit down with a 20-something-year-old teacher and show them what that can turn into in an extended period of time. It's pretty mind-blowing. And so, again, just getting them to be able to see the value in that, and understandably so, especially when they're first starting in their career. It's, again, they're typically not making a ton of money right out the bat. San Diego, being here, is an expensive place to live. A lot of them are trying to buy houses, start their own families, fill in the blank. So this can easily take a back seat. But getting that understanding of small amounts can really add up to long runs. And it is a marathon, not a sprint. But they have the advantage of, in theory, an escalating salary that they know they can continue to just kind of plug away and put more and more into it slowly over time. And that is a value where commission-based people, or people who maybe have higher risk, higher reward jobs, might be more tentative to put money away because they don't know when the next check's coming or what the next check's going to be, per se.
Yeah, I can attest to your skill with working with young people. My daughter's been investing now already for 2-3 years, and she once in a while she'll text me and say, hey, I upped my monthly contribution.
Yep.
So I told her, I don't have millions to leave you, but I have advice to help you avoid some of the mistakes, just the mistakes of waiting, right? I was talking to someone the other day about setting up a financial plan, and they said, I'm just waiting. I'm waiting until I need to do this. I need to buy a car. And I said, so, okay, but did you wait before you had your kids? Mm-hmm. Were all your kids perfectly planned down to the day? And no, I mean, life happens, and you kind of bob and weave with it, and you keep moving forward. And so without a plan, I think, is where we run into trouble.
Right.
And probably maybe this is a generalization, but I would say that for most people, having some sort of a plan, even if it's not perfect, is way better than having no plan.
And the other thing too, I think, that I find when I sit down with people and we start trying to plan, especially with like a younger client, and we start talking about retirement, right? And let's say like you have a single teacher, not married yet, no kids, and we're like, hey, what are your retirement goals? Again, and I know this from asking that question, the reality is whatever their goals may be right now, it's probably going to change like 10, 15, 20 times by the time they actually retire. But the goal is, if you can just start trying, like, well, hey, maybe this is where I want to go, like not 100% sure, but let's just start with that, right? And you start charting that course, start planning towards it, with the goal of reviewing it, right? And I always make that analogy to educators of like writing a long paper, a thesis, right? The goal is to just kind of, this is the most complex term, but barf out the overall theme of what you're trying to say in an essay. But you're going to have to revise it, you're going to tweak it, you're going to edit it, and you're going to take a bunch of different runs through that before you have the final piece. But the goal is just to at least get the meat and potatoes of what you're trying to say on there. So the financial planning aspect is kind of the same thing. Like, hey, let's kind of throw some stuff at the wall and put together an idea of what we think we might want to try and do, with the goal of constantly coming back, revising it, discussing it, knowing that it's going to change. But if we can start now, even if it tweaks and winds and weaves 20 times, you have a much better chance of ultimately getting to whatever your final goal is, even if it's way different than your current goal, if you start sooner and start talking through it more consistently.
Yeah, I know they talked to Warren Buffett. Everyone's expecting that he gives up some great secrets, and he said, part of my success is I've just lived a long time and kept investing, had a plan, had a philosophy, and just kept doing it. And he's 90, whatever, right? Obviously, he made some decisions that set him up on that trajectory. But yeah, time is a great asset if you use it.
He said his famous quote is, I'll probably butcher the exact wording, but it's either compounding interest works for you or works against you, something along those. And it's, again, it's the most powerful thing in the world. If the money is compounding and growing in your account, it is the biggest detractor of financial success if it is debt accruing in somebody else's account against you.
Right.
And so that's a huge concept to understand, is what compounding interest can do to help you from an investing and saving standpoint, but also what it can do to
hurt you,
harm you if you get yourself into a negative financial position. Now, that being said, and like full and fair disclosure, like I've, as a financial advisor, everybody says don't go into debt and, all those kind of tried and true things. People are going to make mistakes. I mean, I ran up a credit card bill my first 5 years out of college and then realized, oh my gosh, I shouldn't be doing this. I should probably walk the walk if I'm going to be giving other people financial advice. And it took a while and some time and effort and some hard decisions to get myself out of that. But it's also, I've learned that lesson and I've seen it firsthand on how important it is. And a lot of times, I mean, people do have to make their own mistakes to a certain extent, and you can give them as much advice as you want. But the people that are going to be successful are at some point are going to realize like, all right, I can't keep doing this and I'm going to have to change course. And that's where we can step in and hopefully help them.
Yeah, I mean, I know there are people who've made millions and millions of dollars off of giving really extreme advice, like never be in debt.
Yep.
Well, most people can't buy a house for cash,
Correct.
And most people can't buy a reliable car for cash either.
Yep.
So I was watching a clip the other day, and I won't mention who it is because that's not the purpose of the show to cast aspersions, but an advisor who's very well known, and you recognize his face, and he said, "Can you believe the average car payment in America is $520? Do you know how much that is if you?" I'm like,
yeah.
Oh yeah, well, you know how much it is when you have to worry about whether your car is going to break down every day
Yep.
on the side of the freeway.
Yep.
That has a cost.
Yep.
Has an emotional cost. It has a financial cost when it breaks down. Same. So yeah, I think there's a lot of oversimplification out there, whether it's people going, oh yeah, invest in this penny stock, you're going to make millions, or whether it's people with having a framework of advice where they go debt free and this is the way you go and always be debt free. I'm like, okay, So then what's going to happen? You die, and then what happens?
Well, that's,
do you enjoy your life?
I always tell clients the same thing, and a lot of people, if we're thinking of the same person, bring up those kind of principles. And I mean, I get it. When you're speaking to a broad audience,
Yep.
you probably don't want to give too much leeway because then somebody might overdo it and be like, oh, well, they said it's okay to do a little bit of this. But in reality, if you kind of take that as a black and white comment on what they're saying to do, part of me, and I always tell clients, I'm like, well, when do you get to live, right? Like, okay, yeah, you're not going into debt, which is great. You're saving up all this money, and then you die. Like, part of doing this and being fiscally responsible and making good decisions is so that you can enjoy the fruits of those labor too. And a lot of times too, as again, especially with educators in this area where it is expensive cost of living, like the reality is like, yeah, in a perfect world, if you've got $6,000 extra of cash flow every month to just like do all these things with, you can set yourself up perfectly. The reality is a lot of times you're sitting down with somebody who's got kids and a family and they either own a house or trying to buy, and they're like, we've got $300 extra every month or $400 extra every month. Or they come, they're like, I don't think I have any extra money every month, and we have to help them try and cut back on certain things or find certain things. So there's a balance in life where like you only do have one life to live, and like that, I'm not advising to be fiscally irresponsible, obviously, but you can do a little bit of both. And I always tell,
go buy Dogecoin right now, everybody.
Exactly. But ultimately too, it's like clients, they get a raise and they're like, well, should I save it all? I'm like, well, let's look at your financial plan, see where you're tracking towards your goals. And it's like, hey, you've got an extra $500 in your paycheck every month. Let's put $300 towards whatever your savings and future goals are. Let's take $200 and you can go out to dinner a few more times every month or whatever you want to do.
And it's interesting too. I was having a conversation with a teacher recently, and they'd gone on to the state retirement portal, and you can put in your years of service and get an approximate amount that you're going to draw in retirement based on your years of service and highest salary. Obviously, there's some variables, but
sure.
And they were surprised by how high it was. And I said, you need to realize, I don't know, choose a number, $50,000 a year for the rest of your life with an inflation buster built in. Mm-hmm. And I said, technically you're a millionaire just with that. You're gonna be a millionaire at retirement. They go, what do you mean? I said, for you, I said, the average person out here who's in the private sector, who you in a lot of ways envy because you look at them as so highly paid in comparison,
sure.
For them to be drawing $50,000 for the rest of their life and not pull down their principal. Mm-hmm. They gotta have $1 million in a 401k or some similar vehicle, right? And it's like, so I think that's a positive thing, but it's also tricky, right? For people's mentality and psychology around money as they go through life. Like I think it's equally dangerous to think you're less prosperous than you are than to think you're overly prosperous because you're living off of high interest credit card debt.
Right. And there was a good commercial a while ago from ING. You know how they have like the little orange like rabbits and animals that are like, I'm the orange. So they did. It's cheesy, but the concept is actually good. And the whole point of like doing a financial plan and putting all that stuff together is like, it was like the orange money and the green money, and I forget which color was which, but it's like the orange money is my money that I'm putting away for the future,
right? And
the green money is my money I can spend now, right? So the whole point is to say, and you take a teacher, you say, all right, when do you want to retire? And they're like, I want to retire at 60, 63, 65, whatever it may be. Okay, how much money do you want to live off of? I want to live off of X amount of money. Project out their pension, say, okay, at 65, you're going to get, let's just make up numbers, you want to live off of 75 grand, you're going to get $60,000 from your pension. We have to make up $15,000 every year, right? So we say, okay, you're 30 now, 25, 40, whatever age you are. If you take X amount every month and you save that, assuming a reasonable rate of return, you're going to build up a large enough pot of money to be able to fill in that $15,000 shortfall.
Right.
And so the goal is to say, okay, well, let's just say that number's $500, right? So you got to save $500 every month. Now, again, return assumptions are just that. They're assumptions, so your returns might be higher, they might be lower, so there's variability in all the plans, and we want to make sure that, we understand that nothing's set in stone and none of this is guaranteed because a lot of things can change. But the goal is to say you need to put $500 a month away based on your projections and assumptions. Let's say you've got $700 a month. That's, again, that orange money is the $500 to make sure that you're on track. The $700 or $200 extra dollars of that $700, that's money that you can enjoy today. Now, again, I would, as a financial advisor, say, well, why don't we be cautious and let's save $600 to be safe, to assume maybe our returns are lower than we expect or your expenses might be higher. But still, the $100 now is your green money, right? So the goal is to say every month, I'm doing enough to feel confident that I'm being financially responsible, saving towards my goals, and I feel like I'm on track. And therefore, I know that I can still have some fun, and whatever my green money left over at the end of the month is, if I go on a trip or I want to go out to dinner or go hit happy hour with my friends, whatever it may be, you don't feel guilty about that, and you can do it, and it's within your budget and financial plan. And that is in the simplest form, and this is an oversimplification, but that's what we're trying to get people to.
That's a good image for folks to remember. What does it mean to be a fiduciary? You brought that up a couple minutes ago. What does it mean to be a fiduciary? Why is that important, and what's the alternative?
Sure. So fiduciary simply is you're obligated to act in the best interest of your client. So decisions that you make should be free from conflicts of interest, i.e. you're not making decisions that are lining your pockets at the detriment of your client. So when you're sitting down with somebody who's trying to give you advice on your money, a good, very easy first question, or one of the first questions, is, are you a fiduciary? And if they can't answer it in a simple yes or no, may want to just think about that. But ultimately, as a fiduciary, it means you're giving investment advice and investment guidance, and you're not selling a product. So the way that the fees of a fiduciary are structured is it's typically a flat management fee. And so the thinking is, if they're managing money for you and they're not earning any commissions or any trading transactions, if they call you up and they say, hey, David, I think we should switch from this fund to that fund, or I think we should tweak your strategy from this to that, in the back of your mind, a lot of times clients might be like, okay, well, is this really a good idea, or are they just trying to make a commission here? Like, is this really in my best interest? As a fiduciary, that person's not making any more money. And in theory, if they give you good advice and your portfolio performs well, they're going to be making more money too, because your account size is larger. So ultimately, in theory, there's a vested interest in the client's success, because the better the client does, the better the advisor does, and therefore we're kind of sitting on the same side of the table as you. A broker is the opposite of it, and a broker is somebody who's selling a product. So they're sitting across the table from you, and they are recommending a product for you to buy, and they're earning a commission from it. Again, like if you're going to commit fraud or do something really wrong, and again, fiduciaries can commit fraud and do bad stuff, and there's plenty of instances of doing that. It just, in theory, a fiduciary is regulated to a higher standard, and therefore, as a client, you have more hopefully A, comfort, and B, if they do something wrong, you have a better chance of getting some sort of recompense from that. As a broker, they can sell you something that you may down the road be like, oh, I didn't really realize all the aspects of what I bought, and I don't think that's right for me. And as long as it's within a quote unquote reasonable standard, there's not typically as much you're going to be able to do. And a lot of times, again, the incentive structure is the broker sitting there and saying, okay, I'm looking at all these different products I can sell. This one pays me 7%. This one pays me 5%. There's going to be an inherent conflict of interest for them to want to offer you the 7% product. Again, there's certain situations where acting as a broker or working with a broker, and we can do both. And so, like, let's say somebody's like, hey, like, I want to buy Apple stock, and I just want to sit on that stock for 30 years. I don't want to trade it. I don't want it to be diversified. I don't want to do anything with it. Well, it probably makes more sense to pay a commission one time to buy it.
Sure.
And then not pay any not paying some sort of recurring management fee if, like, literally you're just sitting on Apple stock.
Sure.
If you're going to have a diversified portfolio and want to be able to tweak it and make changes, it probably makes more sense to be under a fee-based structure where you can move things around and tweak it without having to worry about how many commissions you're being charged along the way. So that's not to say brokers are inherently bad and there's not certain situations where stuff like that makes sense. Or a lot of times if you're buying individual bonds, you buy a bond, you hold it for 5 years, 10 years, whatever it may be. Probably better to be doing that on a brokerage basis versus getting charged a management fee on something that you're just
not managing. Right?
Correct. So, but ultimately, like for us, we're a fiduciary. We can act as a broker, but we're still held to that higher standard of a fiduciary, regardless of the capacity that we're working in.
It sounds a little bit like the way a good lawyer. A lawyer that's doing what they're supposed to do represents their client at all times, right? A lawyer's supposed to at all times represent the best interest of their client, even if that would imply some disadvantage to them.
Correct. And it's the doctor do no harm, right? I mean, similar mindset or concept, right? In theory, I guess in a medical setting, maybe a prescription or an insurance benefit works out better to the doctor, but if this one's better, then in theory they should be prescribing what is best for you, not necessarily what may be the biggest reinsurance endorsement or something like that.
Is there a higher training and licensing bar to clear as a fiduciary compared to a broker?
So Series 7 or Series 6 license is like the general securities license or your broker's license. So everybody has to have that license to do certain things. And then the Series 66 or 65 is the investment advisory license. That is, in theory, if you're acting as a fiduciary, you have to have that because to be able to, act as an investment advisor versus a broker, you have to have that investment advisory license. So that's just a separate securities license offered through our regulatory agencies.
Yeah, I think that's a really important distinction. I know there's some commercials right now on TV where the guy walks in and says, hey, so you charge high fees, don't you? And they say, no, actually I don't. We're fiduciaries.
Correct.
And we have a set fee structure. And
Yep. And that's, is again, ING, orange money, green money is kind of cheesy, but it's not a bad, what they're saying is correct. That commercial kind of cheesy, but that's how it's supposed to be.
I remember this is years and years ago, pre-internet, but I had a little bit of money, a few $1,000s, and I just inherently kind of knew that I need to invest it. It was just literally sitting there in a bank check. And so I went into a Merrill Lynch office.
Okay.
And like a storefront. Yeah. I have my check and I said, I want to invest it. And they kind of looked at me and they're like, how much do you have? And I showed them and they're like, okay. Well, how do you want to invest it? And they go, I don't know. I thought you guys are going to give me advice. Well, and I think if they dropped it in a CD or something, but no one asked me anything. No one explained anything.
Yep. Now I guarantee if you walked in there with $1 million check, they'd say, hey, let's sit down and have a long-term conversation.
That's right. I'm getting gourmet coffee and I'm going in the back room and a bunch of people are smiling at me.
Yep, exactly.
Yeah. So that's the beauty, I think, of the work that you do. And I can attest to the fact that I've recommended folks to you and I know you have clients all over, at all different income levels, age levels, experience with investing levels, and you treat them all with dignity and respect. And I know because I've referred my own daughter to you and my nieces as well. And And so, if you can get teenagers if you can get a teenager to get on a financial plan and stick with it, then you're good at your job.
Well, I appreciate the kind words.
Yeah. What's the biggest mistake you see your clients making with money?
The biggest mistake, and unfortunately this is like the hardest thing for us or any financial advisor to help clients out with, is budgeting. And again, we can recommend strategies, give them tools, but ultimately, like we don't see their day-to-day income expenditures. They can tell us like, hey, here's how much I make, here's how much I spend, but ultimately trying to put together a legitimate budget and kind of categorizing, here's how much money comes in every month, here's where it comes from, here's how much money goes out, and here's where it goes to. And by the clients of mine who have taken that seriously and done the budgets, are amazed at how much extra money they can find and how much progress they can make towards their goals, versus the ones that don't are always kind of like, oh, I guess maybe I'm trying to save a little bit more, but I don't know if I can. I'm like, have you done the budget? And they're like, no, I need to do that. And it really comes down to, like, I always try and look at budgeting as like 3 separate categories. So you've got your necessary expenses, which are, as they sound, the necessary ones, right? You got to pay your rent or mortgage, you got to pay your insurance, you got to put gas in your car, you got to put your groceries on your table. The basic things that every month we just kind of need to survive, or you'll get in a lot of trouble if you don't pay. Second category is I put it in quotations, necessary expenses. And those are the things that are, in my mind, necessary for a well-balanced and happy life. Again, you may not need them to survive. And like we were saying earlier, some people who are very extreme on the financial planning, it's like you have to do all of these responsible things and you can't do anything that's not frugal.
Right.
Again, you have one life, and again, assuming you budget it out and look at everything appropriately and assess your goals, most people can find a way to do some things every month that just make them happy but are not, 100% necessary. And then there's the unnecessary expenses, and everybody's category is a little different. So like me, for example, obviously, again, I got my necessary expenses. I have to pay, rent or mortgage. I have to pay my insurance. There's certain things I have to pay every month. My quote unquote necessary expenses that are not 100% required for me to survive, but for me is golf. Like that's my 4.5 hour, 5 hour getaway from the world every weekend. It gets me outside. It just makes me generally much more happy and able to deal with a lot of other stressful and difficult things in life if I can get around to golfing once a week.
Right.
And so I'm like, all right, I'm going to prioritize my financial plan and my budget to make sure that I have enough money to allocate towards that. Now, for me, things I don't care about clothes. My wife gets mad because I've worn the same pair of jeans for, 7 years now.
Full disclosure, you're wearing a golf shirt.
Yeah, correct. Exactly. Exactly. So, and so it's like, for me, I look at my budget and like coffee, right? I don't need a fancy Starbucks drink every morning. I can press the Keurig button and do it for 25 cents. I'm fine packing my lunch and just making double for whatever I make for dinner and bringing it versus going out and getting a $25 sandwich. So stuff like that, I'm like, I don't care about. That's fine with me. I'm willing to sacrifice. And if I add up all of that at the end of the month, that means a lot of extra
rounds
money.
Of golf.
Correct. Yeah. And so I always try and encourage clients to like find those things. And a lot of times clients are like, oh, when I budget, like I'm not going to be able to do anything, right? Like I'm just going to have to, sit on the ice cube in the corner all day. And so it's like, well, no, look, you can, again, and some people's thing might be Starbucks, right? I'm like, hey, look, if you're stressed, you got a busy work, and like getting that cup of Starbucks every morning and that hot little cup of whatever Frappa, Mocha Elite, I botched that. You might have to kick that one out.
No, I think we'll leave it in because you're making your point with
Frappa, Mocha Latte, Chino, whatever they're called. I don't even know what they are, but ultimately, like some people are like, that's my thing. Like that just brings me joy in the morning and it makes it easier to get through my day. I'm like, hey, rock on. That's what you want to do. But we may have to find some other things to cut out. And so everybody's individualized and everybody's different. But I guess after I'm rambling here, get back to your point, budgeting is the biggest mistake that I see people doing in the sense that a lot of people don't do it.
Yeah, and I think because financial decisions are so laden with emotion, and do I deserve this or not, or should I have this, or I've always had it, or I grew up with it. And I was reading something recently, I think it was in Harper's. I was in the airport, and Harper's magazine has a list in the front, and it has stats, and it said like, what percentage of Americans, blah, 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 what percentage of Americans do the dishes by hand every night. Just weird, useless facts.
Sure.
But one of the things that caught my eye was the percentage of Americans who have no idea how much they spend on monthly streaming services.
Mm-hmm.
And at least according to that stat line, I'm sure it's not perfect, but it said 100%.
Yeah.
So full disclosure, I'm not sure in my case.
Yep.
Because it at $6 or $8 a pop, you're kind of like, that's a cup of coffee. Well, you might be paying for, 50 cups of coffee a month, and you're only using a few of them.
Yep.
It's interesting how we make those decisions and let it slide.
And the budgeting thing is interesting because there is you made a couple good points there. One is the small transactions make or break budgets typically, right? So it's like you're going to go buy a new TV or a new couch or big ticket item. You typically are going to be like, all right, how much money do I have in my account? Can I afford this?
Right.
Etc. You go swipe for $5, $10, $15, and the ironic thing about the streaming services is it was supposed to be like the cable killer, and you're spending $200 a month on cable, and now you're spending $200 a month on streaming, and it's like, well, kind of in the same spot now. You just have all the streaming services, but that's the biggest thing I always notice is like because a lot of times people are like, where does my money go every month? Like I feel like I don't spend that much. It's like, all right, go add up instead of filling up your Hydro Flask water bottle and taking that with you versus getting a $3.50 smart water at the gas station every day, or again your coffee, or I didn't bring a sandwich, so I'm going to go to Jersey Mike's and pay $10, and you add up those $3, $5, $7, $10, $15 that is very easy to do because you're like, yeah, I can afford $5 or I can afford $10, but you multiply that by how many times people do that in a given month, and a lot of people don't realize that, and you add up that final number, they're like, oh my gosh, there's a lot of things I'm spending little amounts on that equate to a lot.
That really add up. Yeah, I was talking to somebody who had recently quit smoking,
mm-hmm.
and obviously the health benefits of that are not even worth talking about because we know exactly what those are. But the financial side of it's really interesting.
Yeah,
they were spending hundreds and hundreds, like a car payment a month.
Yep.
And they never woke up and said, I think I'm going to cut back on smoking because of the financial burden. But that was a benefit afterwards, right? They're like, oh, my God, I didn't get an extra $600 a month.
Yeah. Even, a lot of people, I think, during COVID when nobody was going out, like you're spending less just because you literally can't do certain things. But a lot of those little things that kind of happen as you're out and about living your normal life, just you're not put in those positions where you're again buying the water at the gas station or getting a sandwich versus eating it at home because you're stuck at home. I think a lot of people are like, wow, my credit card bill is like nothing this month because you're just not in those positions where you can do those little transactions as easily.
Yeah, the credit card companies didn't like COVID that much.
Correct.
But people are back to being highly indebted again. So I think it didn't take long. People paid off a lot of balances with the federal stimulus money, but I'm sure they're back too.
Well, I saw a statistic the other day. I think personal credit card debt is at an all-time high right now. So
yeah, it didn't last very long.
Yep.
What advice would you give someone middle-aged, 45 years old, who has a stable job, but has no idea where to get started with financial planning and investing, and maybe intimidated by the prospect of it, right? I think estate planning is probably the top thing that people postpone. You kick down the road because none of us are ever going to die.
Yep.
But probably close second is making a financial plan. What advice would you give to someone who is in that situation?
Sure. I would say, again, it comes down to sometimes it is, I guess, like an ego thing to an extent of like just kind of admitting you need help, but also just prioritizing it. And there's certain things in life that are important and time sensitive, right? Like your tire pops, like you're going to take care of that. You have to, otherwise you can't get around. Certain things like this are important, but not time sensitive.
But not urgent.
Correct. So, and that's in life in general, that's just human nature is people are going to kind of put those things off, and estate planning, like you said, is probably top of the list. So it's easy to just say like, this is important, I need to do it. But if I don't do it, if I do it next week versus this week, that's not going to make or break. But so I honestly don't know if I have like a set thing I would say other than like, just find somebody to talk to and make the appointment. If you can get a good advisor they can, again, even if you don't know what to do, how to plan, we have questions, we have processes, we have things that can take somebody like that who's like, I don't know what to do. I know I'm not doing anything. I know I need to do something, but I don't know where to start, what to ask, how to go. And honestly, that, again, like I said at the beginning of the talk here, like those are my favorite people. It's like, oh, this is awesome. Like this is an open canvas. Like let's get to work and do something cool. So I mean, again, if I had the answer to how to get people into my office to motivate them to do that, you let me know. But
how has the emergence of cryptocurrencies like Bitcoin and Ethereum and some of the funky ones like Dogecoin, although some people don't think that's funky, how has their emergence impacted your work with clients and just the general financial planning and investing landscape in general?
So you made a good comment about Warren Buffett earlier about kind of setting a plan in place and sticking to a disciplined and time-tested plan. And again, this is no comment for or against cryptocurrency, but cryptocurrency kind of became, well, I guess in 2016, 2017, when Bitcoin went to 19,000 or whatever it was. So anytime you get those like speculative fevers, whether it was 2017 or 2016, I forget what year it was, or recently, and even like in 2021 when like Bitcoin was going crazy and all the meme stocks, right? So the GameStop, the Bed Bath & Beyond, all those things. I notice a lot of clients, and this is the kind of the plight of the common investor, is they tend to buy at the top and sell at the bottom, right? So by the time those things have hit the news media and the frenzy started, is usually when I start getting those phone calls of like, oh, should we buy Bitcoin or should we buy GameStop or what do you think? I want to put money in fill in the blank. So right now, since Bitcoin and crypto has kind of fallen off a little bit, I don't get as many inquiries about it. It's an interesting space. I mean, I think there's, as with any emerging technology and thing, there's a lot of fraud, there's a lot of issues and a lot of probably unscrupulous things that are going on there. But the technology within and blockchain and some of these things within there probably to an extent will end up being like the internet, where again there's going to be the pets.com that go under, and then there's going to be the Googles, and so that is an emerging space and an interesting spot. And I do think more clients are noticing it and getting interested in it. So I think you can't ignore it. But I think if you're going to get into that space, you have to do your research, and there's a lot of potential pitfalls. And even with, I guess, Bitcoin, which is in theory the most safe and secure, there's still a ton of speculative risk, and making sure if you're going to do it that it's custodied properly, and just there's a lot of things that you need to look into before you get into that stuff. So I think it's growing. I think clients will be more and more interested in it, assuming the space continues to grow, which it has been. But overall, it's not regulated, and so we're not really able to give like specific advice or guidance on cryptocurrencies specifically. Like I can't say like, hey, I think Doge is better than whatever, right? I do think more and more clients are allocating some of their net worth to it, and as that happens, my hope is that the regulatory environment will change such that we can incorporate that a little better into our advice. But personally, I'm an interested bystander in it. I think there's some fascinating things that are coming out of it and could be really valuable in the long run. And as I said, I think there's a lot of just kind of garbage that's probably somewhat fraudulent and not there for the right reasons too.
I'm intrigued by this notion of being able to transfer money immediately or almost immediately, as opposed to going through so many intermediaries that some people will tell you are there for regulatory reasons.
Sure.
But they could also be there just because people are feeding off of the money flow.
Yep.
And the idea that when someone swipes their card at Starbucks, or maybe Starbucks is not a great example, but you go to the market somewhere and they have that little square thingy on their phone, and you buy some cucumbers and you scan your card, and you walk away and you make salad that night. That vendor might not receive that money for a couple days because it's got to pass through this clearinghouse and these people, this company to check if and so I go, that's just, to me, I think there's liberty that comes in being able to say, I owe you $1 or 1 unit of whatever this is, and you say that I owe it to you, and I agree, I give it to you, and there's proof that I gave it to you, and we're done.
Well, not even that. Your example of going down to the local store and buying something. Imagine being a international business and transacting in different currencies and having to go not only through some sort of payment processor, but also a currency broker and a foreign exchange and all of that. Whereas some of these technologies, in theory, allow you own a business in China, I own a business in the United States, I want to buy X from you. In theory, there's a way for us to transact immediately without any sort of major middleman, and that could be the value of some of those things in that space. And again, that's no comment on any specific crypto or what people should or shouldn't do, but that, to your point, I think is one of the interesting and potential valuable things that may come out of that space. But again, ton of risks. It's still speculative, and as with all of this stuff, it's going to be playing out over the next 5-10 years, and we'll see what ultimately comes out of it.
Yeah, I was reading about a transaction. I think it was in a book on Bitcoin anyway, because I've been fascinated by this for quite some time, and I've made the mistakes that you've referred to. So I am by no means a Bitcoin multimillionaire, but I was reading a book about this older gentleman in Argentina who wanted to sell a condo that he had, a really nice condo, and for $1 million. And so he wouldn't accept anything but US dollars as a currency because the Argentinian currency was so volatile.
Right.
And the problem was the buyer had Argentinian currency, but by the time they went to transfer it into dollars, first of all, they lost a lot of money in the transaction, but the thing was so volatile. So they figured out a way to get him the money in Bitcoin and made the transaction from one cell phone to another. And yeah, there's still some volatility, but they cut out massive transaction fees. Yeah,
There's
it was interesting.
Have you read the Bitcoin Standard?
No.
No? So it's Safadine Amos, I think he's Amos is how you say his last name.
Yeah, I'm going to write it down here.
He's an old school guy from like the Austrian School of Economics. But anyways, if you're looking for, I think in my opinion, like a foundational understanding on Bitcoin specifically and like what it could be or kind of its potential future value based on actual economic background and currency theory and fiat, etc. It's a great, again, no comment whether to buy Bitcoin or not, but just a very interesting take on what Bitcoin is and what it could be, and kind of, again, just the evolution of that space. So
Safadine Amos, Ammous.
Okay, yeah, I thought something like that.
Yeah. All right.
Yeah, the Bitcoin Standard.
That sounds great. I'm always on the hunt for it, because you find books where people are just talking about getting rich, and I look at that and I go, that's not. If it was that easy, then everyone would be doing it. That's
actually a great point too, and something I meant to mention earlier is the kind of Warren Buffett, like, I hate to say it, but like boring. Our goal is always, like we say, we want to hit singles, right? Like, you want to put points on the board, you don't want to strike out, and you want to just continue to run up the score. You try and swing for the home run. Yeah, that's fun if you can hit it, but you're going to strike out way more often than you're going to make contact. And so ultimately, just kind of general advice too is, like, if something sounds too good to be true, or if somebody's coming at you with like hey, I've got this one thing, it's going to solve all your problems, and it's this, that, and blah, blah, blah. I mean, that's just, there's no silver bullet with this stuff. And again, there are people that, again, make a great trade, get lucky, right place, right time, and yeah, they can become very wealthy overnight. But you can lose everything overnight. And I always kind of equate it to, not to equate investing to gambling, but like if you look at a casino, you can go walk into the casino doors and you can put everything on red or pick your poison of whatever game you're going to play. And occasionally somebody hits it big and wins big, right? 99% of the time that doesn't happen, and the house is going to win.
That's why the house has a really big house.
Correct, exactly. So the thinking is, if you are kind of trying to like time the market or buy the hot stock or chase the latest cryptocurrency, meme stock, whatever it is, you're opening that casino door and you're walking into it and you're betting against the house. by investing and using diversified, balanced portfolios and time-tested principles of just kind of rules-based strategies, you're investing in the casino. There's going to be some days where you take some losses, but over time and on a consistent basis, the house is going to win. And so that's kind of my way that I try and approach it is stay away from the I'm going to walk into those doors and get rich overnight type of things, and do the boring, unfortunately unexciting things that will slowly help you accumulate wealth over time.
I'm amazed by hedge funds and the concept behind hedge funds. And people are clearly, hedge fund managers make billions and billions of dollars, some of them, and they buy the New York Mets and they outspend every other team in baseball and those sorts of things.
Yep.
But I'm amazed that wealthy people invest their money in hedge funds, and the hedge fund managers really have no. I mean, they have an incentive to grow the money, but they even make money if they don't make money for their clients. They charge a fee and then they take a hefty cut of the profits.
Yep.
And I think that in my mind does a lot to skew our perception of what long-term investing should be. Clearly, if the wealthy people are smart about it, they also have money diversified in other things. So you're only seeing the sexy part of their investments.
Correct. I mean, in some way, and again, not to say, because some hedge funds have done very well, but the interesting thing is because they are quote unquote hedge funds and they're not necessarily following a specific strategy, you look at a given year of just like the market, and let's say the market's up 7%, you're going to have some hedge funds that are up, 85, 100, 200%. You're going to have some hedge funds that lose 30, 40, 50%. Whereas like if you buy a growth mutual fund and the market's up 7%, some growth funds might be up or down a little bit more than the market, but like you're not going to find a growth mutual fund where the market's up 7% and you lost 10%.
Right.
But to your point, and that very great point, is most people that are getting into hedge funds or private real estate deals or, kind of the, as you said, kind of sexier or alternative type of investments that sound cool at cocktail parties. And again, some of them do great and can make really solid returns if you're in the right ones at the right times. Those are people who have maxed out their 401ks, maxed out their kind of traditional, again, balanced, managed, diversified portfolios. And they're like, I've still got money to left over. And I've got a $20 million portfolio. If I put $500,000 into this kind of alternative speculative investment, if it blows up, I've still got $19.5 million and I'll be just fine. But if my 500 turns into $2 million, then I'm sitting pretty and I'm willing to take that risk. And so those are people that have the luxury of being able to do some interesting stuff like that. And you get clients like that, that's a ton of fun because then you can start to kind of find some cool stuff. But that's, again, you have to get yourself into a position where you can say, hey, I've got the bulk of everything and kind of, again, the boring, slow and steady, tried and true stuff. And I'm willing to take some risks with some of this outside capital that if I lost or had really poor returns on, it's not going to make or break me.
I just have a couple more questions for you, Eric. And again, I wanted to thank you for your time this afternoon. I know that you're busy. And I hope we're not taking away golf time from you too. That's Saturdays,
it's
right?
Only weekends,
Only
man.
weekends. In a couple of years, you'll be able to. When you get to be my age, you can probably play golf during the week too.
There we go.
When you're old like me, no one questions it when you're walking around the golf course. What ways? What? Let's see. How do you think schools, since this is a lot of our audience are educators, how do you think schools can improve the ways that we prepare our students for a life of financial literacy? The state of California recently, the governor and the state superintendent of education have used their bully pulpits and some significant resources behind incentivizing school districts to build courses around financial literacy. So I think the time is right. What can we do in education so that our students in the future won't repeat the mistakes maybe we've made?
Sure. Well, I think, it's great that the state is starting to prioritize that. And I think it's super valuable because ultimately you never know what direction a child's going to end up going in life in terms of their career path or just, how they're going to end up. But ultimately, regardless of where they go, a universal skill that everybody needs is financial literacy, right? And so again, if you go into an engineering career, math is going to be more important to you. You go into a, scientific or doctor field, biology is going to be more important to you. Either one of those career paths still entail needing to have some sort of financial literacy. So I think it's great that they're starting to do that. I mean, again, keeping it simple and fun, like going back to my example with my dad, the reason I got into it and interested is it was fun. Like going to work with my dad and financial stuff aside, like the environment was enjoyable. So I think whatever, I mean, this is where you'll know way better than I do in terms of how to motivate and get kids excited about something, but finding a way to make it less about the like math and scientific approach to investing in financial wellness and equating it to some sort of like fun, exciting environment that gets them motivated and excited to actually dig in and learn about it. But I think honestly, I mean, if that's going to be implemented more regularly, I mean, keeping it simple, like again, none of this stuff, obviously you've got a super complex, wealthy individual. There's some complicated things. But again, for the average American who's trying to save monthly for their retirement, help put their kids through college potentially, make sure that if something happens to them that their family is going to be taken care of, those things are not that complicated, assuming you've done a good job of kind of keeping it simple and educating kids on that. So I think just keeping it as simple as possible. And I guess to my point earlier would be budgeting. Like I think if you could get every kid out of middle school, high school, whatever it is, with actual skills that they could take away on how to do a budget, that would be huge. Because as I said, the biggest issue that I see with clients is not having a budget and therefore finding it difficult to allocate money towards all these things that they're trying to save and invest for. So I think budgeting skills would be the hugest focus for me, at least as far as like financial literacy for kids goes.
And we're very fortunate to live in a country where we have no shortage of choices. Financial instruments, different places to go for information. Yeah, it can sometimes be overwhelming, but it's certainly much better than the alternative where you speak to folks in other countries and they just don't have a lot of opportunity. Even some countries, the banking system is so unreliable, people don't like to use it. Mm-hmm. Notwithstanding the recent bank closures that we've had, but those are massive outliers when you think about the number of banks that are operating responsibly in the United States.
Yep.
Even thinking about the ways that in a responsible manner, people can do things like buy a car as opposed to the irresponsible manner. Yeah, most people need to take out a car loan, but there are good car loans and not so good car loans.
Yep.
And all those pieces. My daughter took a financial literacy course in college and rather in high school, I should say. And so now that she's in college, after her first year in college, she and I went to I helped her buy a car, and she said, "Oh, they taught me about this, that when the economy's this way and interest rates are this, it may be better to buy a new car versus a used car." And so those are lessons that I think can be almost immediately relevant to kids, because so much of what students learn in school they believe is irrelevant, or they always ask, why do I even need to know this?
Yeah. No, I think the financial literacy is a very easy answer as to why I need to know this. So I think if you have a kid saying, why is this important, there's no shortage of answers to give as to why. So
yeah. So I have two more questions for you. Okay. One, which is straightforward, and then the other one's a little bit of a surprise question. So the straightforward one. So I know that you're involved in community volunteering and community service, and I know you serve on a charter school board. Mm-hmm. What lessons have you learned in your time serving on a charter school board, and how do you connect that work to some of the skill sets that you use every day in your day job?
Sure. The biggest thing that I have seen specifically for the school that I'm on the board for is just how important communication and teamwork is. You've got, and I'm sure the same thing with you guys here, just such a wide array of stakeholders, personalities, interests, and ultimately it all comes back to, trying to help the kids out, right? Now, different people, whether it be a parent, a teacher, an administrator, a board member, probably has different opinions or perspectives on how to do that and what is best for those kids. So I think just having like a collaborative and communicative environment to where people feel comfortable to share their opinions. Again, assuming everybody's working in the same direction, which I feel like the board I'm on is lucky enough to all have the same kind of shared mission. Again, different approaches, different perspectives, but just making sure that everybody gets a chance to speak their mind, have their opinions, and kind of come to a consensus opinion. As far as how that relates to my job, I mean, I guess, again, sometimes, especially like you're sitting down with a couple, or like a parent and a child if the parent's older. And again, they may have different opinions, different ideas, different wants, different styles, different personalities, and trying to mold a plan or explain things in a way that can get both people on board is really important and valuable, I think. So I'd say that's probably, just off the top of my head, the best thing I can think of. But yeah.
Well, I know that the school that you serve is very fortunate to have you as a business owner and someone with a good financial mind and a good people mind, because your work is not only money, it's probably primarily people.
I would say I'm 25% financial advisor, 75% therapist. So
therapist, exactly. I was going to say that. And myself, being one of your clients, I can attest to that too. Okay, final question, surprise.
Okay.
You're given a chance to create a billboard on the side of the 5 freeway.
Okay.
And people only have a few seconds to look at it as they whiz by. What does your billboard say to the world about your philosophy, either your philosophy on life or your philosophy on your job, or it can be a combination of those two?
I would say something along the lines of each client matters and is unique. And again, there's certain tried and true principles of, like, don't go into a ton of debt, or don't chase the latest meme stock, or fill in the blank of some stuff that you just shouldn't do. But each person has different goals, different time frames, different fears, different wants. And there's definitely not a one size shoe fits all approach. So again, everybody's different. One size shoe doesn't fit all. Fill in the blank of whatever cliche saying you want to use for that. But I think that would probably be our billboard, just because the goal, and I guess we didn't get into this a ton, but my first job that I ended up leaving in financial services, the reason I left it is I was selling a product, and I would sit across the table with somebody, and as much as I was acting as a financial advisor, my company wanted me to do one thing and one thing only.
And that's how you got paid.
Correct. And so the goal of getting into this business was obviously to make a living and be successful and grow my business, but A, sleep well at night, but B, be able to sit down and not have a pre-target. Like, I guess I'm in sales, but I don't really like selling. So I don't want to have to ever sit there and feel like I'm convincing somebody to buy something from me. I want to be able to sit and listen and understand and be able to find something that's unique and fits into what they're looking to do. And then I feel like I'm not really selling them on anything. I'm actually finding a solution to a problem. So I guess maybe I'm not the best wordsmith in the world, but some sort of iteration of every client's unique, or just one size shoe doesn't fit all, or something along those lines.
Yeah, thank you for that. I think it speaks to your philosophy of work and also of life. So I really appreciate that. Where can people find you online, and what's your URL and your phone number?
Yep. Yeah. So website is www.eandefinancial.com, and the and is spelled out, so it's not the ampersand. So EANDE financial.com. Office number 619-487-9638. And then you want an email too?
Yes, that would be great.
So Eric, ERIC, at eandefinancial.com. And again, and is spelled out, so EANDE financial.com.
Thank you for that. And for all those who are listening, you reach out to Eric and you're going to hear back very, very quickly. I found out part of that is because he has a fantastic assistant who gets back and gets you organized and gets appointments set up. So when Eric, if on the Saturdays, even if you reach out on Saturday, you're probably going to get a response really quickly.
Yep.
So
Bonnie and Tina might have the
competition
as the two best.
So thank you so much, Eric. It was a real pleasure sitting down with you, and hope we'll have to do this again soon.
Would love to. Pleasure to be here, and thanks for having me.
This episode is brought to you by McGriff Insurance Services and Senior Vice President Mike Lutosky. For over a century, McGriff has focused on building long-term relationships to deliver innovative insurance solutions. The McGriff name dates back to 1886 and the founding of McGriff, Sables and Williams. Today, McGriff is part of Truist Insurance Holdings, Inc., one of the top 10 largest insurance brokers in the world. McGriff provides highly consultative risk management and insurance solutions for businesses of all sizes, as well as for personal insurance needs. Coverages available include commercial property and casualty, small business, employee benefits, management liability, personal lines, and much more. Mike Lutosky's expertise is wide-ranging and includes transitioning employers from fully insured to partially self-funded medical, dental, and vision programs, HRA wrap programs, reference-based pricing, healthcare pricing transparency, pharmacy consulting, wellness programs, marketing, implementation, and ongoing management of fully insured benefit plans, and much more. Mike can be reached on his cell phone at 619-925-1731. All proceeds from this sponsorship support the Eric C. Mitchell Scholarship Fund at Albert Einstein Academies. The scholarship benefits graduates who exemplify the outstanding human qualities that define Mr. Mitchell's legacy. Thank you for listening to the Superintendent's Hangout. You can follow me on Twitter at DVS1970. Please be sure to share this show with friends and family on social media and in the real world. Thank you to Brad Bacayal for editing and production assistance, and to Tina Royster for scheduling and logistics. Thanks for hanging out, and have a great day.